Well, James here from jamesdforsythe.com. Wanted to go over a recent speech done by Lael Brainard. Oof, excuse me. Um, she's going on about crypto again. It seems like every single time I see anything with her name attached to it, it is either a central bank digital currency or regulating the crypto markets. I mean, that could just be what I happen to come across or whatever she's been doing the past 6, 8 months or so, somewhere in there. Um, Something along those lines. But yeah, I don't know. But it's like every single time it has something to do with those. So I'm gonna not waste any time, head straight into the screen share because hers is it's a bit of a longer speech. Um, so might as well get started. And then I'll try not to forget to switch the screen so you guys can see it better. Okay, so while touted as a fundamental break from traditional finance, the crypto financial system turns out to be susceptible to the same risks that are all too familiar from traditional finance, such as leverage, settlement, opacity, and maturity and liquidity transformation. As we work to future-proof our financial stability agenda, I can't talk, sorry. It is important to ensure the regulatory perimeter encompasses crypto finance. So this is the first time I've heard that specific wording. So I'm not 100% sure what she means by future-proof our financial stability agenda. I'd assume it kind of means like ensuring that the stability of the financial system is basically immune to being compromised from any form of new technology, but it's also like how reasonable is that? I don't know. I'm just a pleb. I'm not a member of the Fed, so I don't know. But that's at least the first thing that comes to mind. All right. So one of the biggest things to continue, right? We're talking about the risks and stuff for crypto. So she gives examples of those as runs, like bank runs, fire sales, selling stuff for pennies on the dollar, deleveraging, interconnectedness, and contagion, along with fraud, manipulation, and evasion. In addition, it is important to be on the lookout for the possibility of new forms of risk, since many of the technological innovations underpinning the crypto ecosystem are relatively novel, right? And okay, this next part that I highlighted in blue, I will bring up later again because she contradicts herself at the very end, or at least it seems to be. She seems to contradict herself, which shouldn't be a surprise. So she says, strong regulatory guardrails will help banks, payments providers, and financial technology companies, fintechs, improve the customer service, make settlement faster, reduce costs, and allow for rapid product improvement and customization. So, for one, I don't think I've ever talked to one business owner, and again, this is anecdotal, so maybe your experience is different, but from the people I've talked to, I can't remember one of them talking about how government regulation actually like improved their product development, like how efficient they were, how like how does the government, who's more broad in scope, obviously they have like more specific committees and entities and our people, and there's obviously like the members and say like Congress or the Senate or whatever have their own specific, I'm going to say niches, right? um and specializations, and so you have that kind of aspect to it, but like are they really going to be able to better run, because that's essentially kind of what the whole doing this is, reducing costs, settling faster, and then product improvement and customization. I mean, that's kind of those all seem to me at least to be business aspects. Like that's something that you're in the business doing that, right? That's not really a government thing. They're basically just there to regulate the hell out of you. That's pretty much it. Um, and so it's kind of them saying that they can run. At least it seems that it's like they're saying they can run their business or the business better than the people who have been doing it for forever or whatever it may be. You know, so at least that's one way you could think about it. I'm sure you could think of other ways, right? So basically, her main argument is like now the right time is to establish which crypto activities are permissible. Wow, I am not getting a good start off to this. Are permissible for regulated entities and under what constraints so that spillovers to the core financial system remain well contained, right? I'm just going to let the rest of the speech speak for itself on that point, right? So, contrary to claims that crypto assets are a hedge to inflation or an uncorrelated asset class, crypto assets have plummeted in value and have proven to be highly correlated to riskier equities and with risk appetite more generally. I'm not really going to argue with that. I mean, when you have kind of in the broad scheme of things, crypto is still a baby, at least I believe. I mean, we're talking about like equity markets that have been around for like hundreds of years, not necessarily just the US stock market. I'm talking about like equity kind of markets in general. Like these are not brand new things from a historical perspective, especially with debt. Like if you want to talk about bond markets, it's been kind of some form of debt market per se for I'd assume basically since human existence for the most part. Maybe not that far, obviously, but no, I'm not exactly know. I don't exactly know what cavemen used for their specific currency, or if they basically just, you know, on a rabbit hole. I'm getting completely somewhere else. But anyways, I don't really have anything contrary to that. I mean, I think you kind of have to think about Bitcoin and then other crypto assets separately. Um, but again, that's not the purpose of this video, so I'm going to continue on, right? So also the Terra crash reminds us how quickly an asset that purports to maintain a stable value relative to fiat currency can become subject to run. The US dollar is the same thing in the past. I'm not saying right now. Um, New technology and financial engineering cannot by themselves convert risky assets into safe ones. Isn't that essentially what mortgage-backed securities are, as an example? Like financial engineering and that sort of thing. And then basically, financial institutions essentially engineering their balance sheets in such a way with the current regulations to seem safer, like, say, providing some form of insurance on an asset to make it rate higher in terms of safety. And so that doesn't affect their, I think, the SLR ratio as much, right? Um, as an example, that's it. So third, crypto platforms are highly vulnerable to deleveraging, fire sales, and contagion, risks that are well known from traditional finance, as illustrated by the freeze on withdrawals at some crypto lending platforms and exchanges and the bankruptcy of a prominent crypto hedge fund. So I'm not huge into crypto itself. I just got rather interested from kind of the money and our monetary system applications of, say, a central bank digital currency, which is brought up later. And that's kind of why I got interested into this to begin with. So I'm not a huge crypto dude. It's just not my thing. Not really what I mean. It's interesting, but it's not my forte. I do have a computer background, so I understand some of the stuff behind it, but I'm not like I haven't done like deep dives into like everything because it's not really a core interest of mine, so to speak, right? But I don't really have an argument for that because I know of one person that I know, and I think it was called Celsius. But like I said, I'm not a huge crypto dude. Um, that to where like he had his crypto in Celsius, and basically they froze it, and he wasn't allowed to get it. Again, I could be getting the name mixed up with something else, like I said, but still, it's stuff like that's happening. Um, Finally, we have seen how decentralized lending, which relies on over collateralization to substitute for intermediation, can serve as a stress amplifier by creating waves of liquidations as price falls. So, one thing that comes to mind is the haircuts that are given to treasuries or just collateral in general in the repo market, because that kind of seems the same thing. Because whenever you give the haircut to the actual, like the repo transaction in general, and you're giving a haircut to the collateral, that essentially seems to me like the whole point of that is over collateralizing the loan for the same reason. Or maybe you could argue that it's to substitute for intermediation, but it's still the same thing, still over collateralizing to kind of reduce the risk, so to speak, right? But on the other hand, I can see what she means by a stress amplifier by creating waves of liquidation. So, but that's kind of, I don't see how that's much different from regular loans if you just collateralize it, I guess, normally. Because either way, whenever they can no longer service the debt and they get liquidated, I mean, that's collateral is just going to go out. It's just going to be now there's more of it that's going to be liquidated and sold at like fire sale prices or whatever happens to be the dynamic for that specific situation, right? So I'm not quite sure what the differences are between that and some of the stuff that already goes on in traditional finance, but still. Um, and kind of her main thing with crypto, or at least I guess the main reasoning that she gives is like same risks, same regulatory outcomes, but basically like having crypto in the crypto, I guess, ecosystem or financial system, however you want to, the crypto space, be essentially parallel to traditional finance, right? To where it's like if an entity, an institution, or maybe a specific coin or asset or whatever poses the same risks as, say, um, something that's analogous in the financial, or I'm sorry, in the traditional financial system, then they should have the same regulatory outcome, right? Okay. So reasoning in implementing a same risk, same regulatory outcome principle, we should start by ensuring basic protections are in place for consumers and investors. Retail users should be protected against exploitation, undisclosed conflicts of interest, and market manipulation, risks to which they are particularly vulnerable, according to a host of research. And you can click on this when you so want to go to the actual research itself. That is the superscript. It'll take you to the references at the bottom. But if investors lack these basic protections, these markets will be vulnerable to runs. But again, she's talking about same risk, same regulatory outcome. So I'm assuming essentially that means giving the same risks, I'm sorry, giving the same regulations to the crypto market that's already in traditional finance. So essentially saying, how does that change whether or not they're vulnerable to runs relative to traditional finance? Because we still have those in traditional finance. So it's like, how does that change specifically? But I don't know. Again, it's just a speech, so I'm sure. I downloaded a few PDFs. One or two of them were papers in which she actually wrote. So I'll go over those like I did the Central Bank Digital Currency reports and kind of could be something in there because I mean you can't expect like a whole explanation within a speech, right? That's not the purpose of the speech. So it's give credit where credit is due in a way, right? Okay, so to continue, um, basically they must comply with the rules designed to combat money laundering, financing of terrorism, and to support economic sanctions, right? So basically, you're not allowed to do anything we don't want you to, right? Typical government stuff, and that's in general, right? So the permissionless exchange of assets and tools that obscure the source of funds not only facilitate evasion, but also increase the risk of theft, hacks, and ransom attacks. These risks are particularly prominent in decentralized exchanges that are designed to avoid the use of intermediaries responsible for know your customer identification that may require adaptations to ensure compliance at the most fundamental layer. So basically, it seems like it's kind of on a way, and it might be a little bit of an extreme push, or maybe I'm pushing too far, maybe based off of ignorance or whatever, but it seems like this is kind of like to make the same risk, same regulation aspect, right? To basically make crypto completely run parallel in terms of regulations to the traditional finance, it seems like that would almost completely defeat the purpose of some of the crypto aspects, right? That kind of make it the reason it was developed, right? So the permissionless exchange of assets, right? It was kind of like cash, but it's like, well, why can't we use cash? I don't know. Right, and to get more specific with that, she lists the peer-to-peer nature of these activities, their automated nature, the excuse me, the immutability of code once deployed to the blockchain, the exercise governance functions through tokens in decentralized autonomous organizations, the absence of validated identities, and the dispersion or obfuscation of control may make it challenging to hold intermediaries accountable. It is not yet clear that digital native approaches such as building in automated incentives for undertaking governance responsibilities are adequate alternatives, right? But it seems like it's just kind of attacking crypto no matter what. So I don't know. Right. And so kind of connecting this to core financial institutions, there are two specific areas that merit heightened attention because of heightened risks of spillovers to core financial system, bank involvement and stablecoins, right? Or just bank involvement in crypto in general, and then stablecoins, right? Basically, and she also argues that the actual bank involvement itself provides a way for regulators to really ensure protection for crypto or within the crypto market, so to speak, right? So that's kind of their window to see everything, right? Is really kind of attacking the intersections between where, say, traditional finance kind of intersects with crypto. So kind of getting into that argument a little bit, right? And then I always think stuff like this is kind of funny, but basically talking about like with stablecoins and how a single dominant stablecoin might emerge given the winner takes all dynamics in such activities. Right. So like basically a monopoly, a stablecoin having a monopoly, but like also how is that different from a world reserve currency, so to speak? I mean, you have kind of a single dominant one, the US dollar, and yes, there's alternatives with other foreign currencies, obviously, but and just as you have alternatives for other coins in general. Like there's not only one stable coin. She does give the top three stable coins account for almost 90% of transactions, and the top two of these account for 80% of market cap, right? Right there. And that's source 9, right? And so I forget the amount. What is, I might be wrong on this, but I think it's somewhere around like 60 to 70% of global debt is dollar denominated. I could be completely wrong and be thinking of a different number, but something along those lines. It's kind of the same thing. Maybe not to the same extent, but I mean, like when you can only really trade commodities in one currency, it kind of does the same thing, but or at least it's similar, we'll say. Right, and this is where we get into central bank digital currency on a digital native form of safe central bank money, as I talk about, could enhance stability by providing a neutral, trusted settlement layer in the future crypto financial system. Right, gotta talk her CBDC. And this is where she contradicts herself with, um, while innovation and competition can reduce costs in finance, some costs are necessary to keep the system safe. And so basically talking about how the regulations are coming in and how those regulations are necessary to keep the system safe. But I thought, see if I can actually get to it on time, um, that they would reduce costs. These regulatory guardrails would reduce costs. But then again, that's maybe there's some nuance. See, I can't even get back. If I ever scroll, I almost always miss it for some reason. But okay. Yeah, so in the current crypto ecosystem, often no one is bearing these costs. So when a service appears cheaper or more efficient, it is important to understand whether this benefit is due to genuine innovation or regulatory non-compliance, right? So basically, is the only reason the crypto industry is profitable, or I guess one of the only reasons, I don't want to be absolute, um, is that they're not complying with typical regulations, right? And so really what they're talking about is like the cost of actually like providing these services, like financial services and stuff in general, right? And so like who's going to hire, say, the accountants or the tax advisors, just as examples, or other kind of, what do they call it? Supervisors, so to speak, to come in and actually make sure they're complying with all regulations, right? Because I know, I think I forget what their title is, but I'm pretty sure there's like some person or position within the Federal Reserve to where they're literally their entire job is they're at sci-fi's systemically important financial institutions. And their only purpose there is to ensure that those institutions comply with regulations, and that's all they do every day. Like, and that's it. So something along those lines, but for crypto, and I'm sure that would go well. Um, but anyways, kind of the main reason I wanted to go over this was one, every time I see anything with Brainard's name on it, it's pretty much always about either crypto or central bank digital currency. So since I've been going on sort of a run on CBDCs and just kind of really looking over a lot of the reports and reading some of the articles and stuff that have been written, even some of the academic papers that they've published along those lines, trying to really kind of understand it and put that stuff out there, so to speak. I wanted to go over this as well and just kind of. I also did something, I think I did a similar video not too long ago, maybe a couple months or so, to where it was something where, again, Brainard was talking about regulating the crypto market, right? And I think that was like in the middle, it was like less than a week after the Terra Luna crash. I think it's Terra Luna. Like I said, I'm not a crypto dude. But, anyways, um, yeah, I'm going to leave it there. So, I hope you guys have a good night, and I'll see you on the next one.